Chicago time on Tuesday, the 8th of August, 2017. Thanks for joining me. 9:02 Eastern U.S. time. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The markets this morning are showing some weakness. Not by much. We're down. The worst case scenario, the Euro stocks, which is the laggard today, is down 0.2% or 7 points. The S&P 500 is down 3.25 points. So we are back to 24.74 and a half. We've seen this. It's incredible. We've seen this price again and again and again and again for about a week. We've opened here consistently. I'll tell you the opens in the S&P. It's a little early in the broadcast to go over it, but just to get an idea, on the 31st, we opened right at 73.75. On the 20 on the first of the month, we opened at 74.75. Then we opened at 75. Then we opened at 73 even. Then we opened at 74.75. And yesterday we opened at 74.50. And currently we're trading 74.50, 74 quarters. So we really, really, really like this price. It's the ultimate, it's the utopia of trading, futures trading equilibrium right here at this price in the ES. So that's where we are. Yes, that is sarcasm in my voice, in that there's really nothing new to talk about. I might as well replay yesterday's Trader Bite, except that we actually managed to get, hallelujah, we got the 78, finally hit that naked point of control, and pushed to 78 and a quarter yesterday. But overall, the market is slightly allocating to safety this morning. The Japanese yen leading the pack, up 28 pips, followed by gold at $1,267.60. Crude oil for September's trading at 49.46. Those are the products that are up. The Euro FX is up as well. Now remember, as I said yesterday, the commitments of traders report shows that the the commercial position is now short the U.S. dollar, and we see that reflected in the price of gold and so on. So that's the overall market condition this morning, just slightly lower, but we're still pushing up against all-time highs. All-time highs in the ES are 6 points away. Again, I want to remind you, the reason I focus on the ES is because it is the most popular futures product in the world. It has the highest number of participants in it, so it addresses most of the audience, although it's not something that I'm trading currently. As of yesterday, the Dow closed in record territory 9 straight days in a row. So it has tacked on a 2.8% during this run. So the Dow has been making new all-time highs day after day for 9 days, while the ES has sat sideways. The China's trade surplus increases dramatically. Imports rose 11% in U.S. dollar terms versus a year ago. That's 11% from 7.2%. That's quite large. And then, of course, Bitcoin has hit 3,500, almost hit 3,500 on a record high on Tuesday. It seems like that's where the money is right now. There's a massive parabolic move bubble in there. As far as what we're expecting, we got some key figures overnight. The German current account and so on. But you can look at those yourself. As far as what we are looking for today during the U.S. session, there really isn't anything that we're expecting today at all as far as economic releases. At 10 o'clock, we get the JOLTS job openings. We're for June expecting 5.7 million. And then after the close today, we get Disney and Priceline, and that is all she wrote. There's nothing else to talk about as far as expectations. Let's take a look at what was expected yesterday. Um, so here's the primary hypothesis is to trade sideways, make an attempt at the high, and then start to flow lower, but overall stay in the same range. Nothing new. As I said, the Monday following non-farm payrolls is likely to see little action. The whole week last week saw 14 and a half points of range in the ES. The entire week. Contrast that with about with the mid 30s since Q2 started, and about 50 points per week on a larger time frame. So we are way below, and I'll show you that in a minute. The secondary hypothesis, which essentially was what happened, it did not go down and form a base at all before going to 78 and then falling off. It did not drop much at all. It actually opened and then started to drift up to 78, and then it just basically sat sideways at 78. That's what happened yesterday. We ended up getting this push, but we got it from the open. And so, yes, I saw that. Doug here is contributing by saying that this was the lowest. Last week was the lowest range week at 136 weeks. I did see that on one of the charts that I saw that I look at on the bigger time frame. So don't despair. This is not the norm. It's not going to be the new norm. The market goes through these cycles. We are still near all-time highs, and it just continues to be so. Yesterday, we were just 2 points from new all-time highs in the ES. We're just now backing off. The market has no reason to back off currently, and it's a little bit extended, so it's not seeing any action from the buyers either, and so it just goes sideways. So this is what happened yesterday. There it is. The entire day is fitting on about 15% of my screen. Look at this Friday, we had a little bit more volatility, and you can see Thursday takes up half the screen. Yesterday on a 2-tick Renko, remember it's not going to form a bar unless there's enough range. You have the entire range in about 10 or 15% of the screen. That just tells you how little action there is. There's just no action in the S&P index right now. The Nasdaq continues to have pretty decent rotations, although it has slowed. But look at this thing; it does have pretty good turns. And as I showed you in the spread ratio chart that I shared last week, the Nasdaq has become a lot stronger than the ES. It used to be you needed more Nasdaq per ES, and now we only need 6 Nasdaq per 11 ES. In other words, the Nasdaq is having about twice the range on an equal basis. Given that it's a $20 point versus a $50 point in the ES, the Nasdaq still needs has twice the power or the range as the ES. So I'm encouraging people to look at the Nasdaq, look at the Russell and others. I just don't see the opportunity here in the ES. Going into the overnight session, an absolute snooze fest, same as yesterday, but inverted. Yesterday went up immediately and then sat sideways and then started to sell off later. About the same range, about the same amount of volume. Last night we sold off and we went sideways, but the profile's practically the same. We're trading it's a mirror image almost of yesterday's overnight session. The overnight inventory is short, pretty much 100% short. We see the delta was even throughout most of the night, but is slightly short currently. So we're looking for that to correct on the open, looking for responsive buying or a rotation up early once we open up. Just a quick look. I want to show you the composite. So this chart here is what I call the composite chart. That's in the title right there. What this chart shows is one bar per per RTH session per day. So this only has the pit session in it, the cash session plus the 15 minutes on the close that makes up the pit session. And what you'll see here is a histogram. This is a histogram that this is a volume profile of the volume in the S&P, and it goes all the way back to this date, right? This date here, to August 24th, 2013. Why that date? That date's the last swing low, clear swing low that I'm charting from. So we're going back about 4 years of data. Each year has about 252 days, call it 250 days. So this is a sample of 1,000 days of volume, and then we create a profile of what the volume looks like. And as you can see from the numbers here, the mode, which is the point of control, the mode, or the most common rounded figure, rounded by in increments of 50,000 per price, the mode is 1.05 million. That's about how much we should expect. We would expect, or that's the most common amount of volume that's traded in the RTH session in the S&P futures. And if you look at what we did the day before, on the 7th, we basically traded 464,000. We traded 464,000. On the low end of normal, we would have traded 760,000. And again, we traded 464,000, way below. You can see that the value area of this profile is outlined by these purple lines. Anything inside of this range is considered normal. Okay, and we've been on the low side of normal, so you can see there's a lot on the low side of normal throughout July. June was pretty good. We were trading just well into what we would consider to be normal. May, same, but then April, we had some pretty good trading in April, good volume coming in. Same thing, let me extend the scale here. Same thing on range. So this is doing the same thing, but charting range. And in range, the most common range for the day in the S&P minis is 10 points. On the low side, we have 6 points, and we had less than 6 points yesterday, and we had much, much less. We're in the second standard deviation. We had much, much less than what we would expect on any given day. So my point is it's really, really, really dry. And if you find that, if you think that there's something wrong with what you're doing, and I'm not going to make excuses for you or your performance, but if you find that it's really, really difficult to find opportunities in here, this is part of the reason why. And what that means is it means you don't excuse the fact that you pardon the expression, pissed away 20% of your account. It just means you need to back off. You need to just back off trading, find something else to trade, or back off at trading. The numbers in crude oil have been fairly consistent, some pretty good rotations of movement. The Nasdaq has dropped off, but still pretty strong. It's the S&P that just has no interest in it right now, and that's what we're seeing. Anyway, that's much longer than I wanted to talk about it. But I want to make sure that you're getting the context and color, and look at this incredibly tight range here that we've been in, and it continues. So this morning, open auction, responsive buying, looking for to attempt at the 78, fail, and I'm looking for a rotation down. We've been consolidating and compressing for quite some time. We've been one-time framing up now for about 4 days. So this is the low that made the turn. We started one-time framing up here, and then we have one-time framing up for 3 days in a row here. And if we see a break of that, we're likely to get down into the MC point of control at 69.5 pretty quick. That's my hypo 1. If we see that, we might get some pretty good rotations today. Most likely, we'll get an open auction. test down first, fail to push through, and then start to trade somewhere in the middle towards the 78 again, sideways. That's hypo 2. And the reason I'm putting hypo 2 second and hypo 1 first, in that we would see a sell-off, is because the amount of compression and the fact that volume absolutely disappeared yesterday, with Tuesday being statistically the more volatile day, I'm expecting rotation down. Okay, so that's what I'm looking at. You can come up with your own hypo 3s, 3, 4, and 5. And of course, this is the time to exercise discipline. This is the time to work on your battle plan, work on getting a better journal, writing your plan if you haven't written one, writing your risk control if you haven't done so. This is the time of the year to clean up. It's not the time of the year just to stare at the monitor and twiddle your thumbs and be frustrated by the fact that there is no movement. Take advantage and go do something better with your time. Good luck.